The reason that we were expecting a small tick-up in inflation this month was because of these so-called annual base effects, which are in the sort of arithmetic, because they're basically a sort of mirror image of what went on a year ago. So they were there. I mean, nothing's changed on those. They're in the arithmetic. So what it means is that there was some more other things going on which were putting more downward pressure on it than we expected. So that's good news. And as far as I can tell, looking at it this morning, that downward sort of that amount of sort of downward movement was pretty broad-based. A bit of it in energy, some in food, but also some in services as well, a little bit. So that's quite encouraging. So yes, I think it leaves us broadly where we thought we were going to be, but that's obviously encouraging relative to where we could have been. I think the big change is that we've moved from, in a sense, facing the question, how restrictive do we have to make policy to get back to target sustainably, to for how long do we have to maintain those stance of policy to achieve that? And that's an important and significant change. And I think today's numbers leave us exactly in that position, actually. And broadly, there are three categories. Services inflation, because that has the highest domestic sort of component in it. And just to put the background on that, I mean, what we've obviously seen inflation coming down very rapidly, and really that is the ending of the global shocks to inflation that we saw, obviously, 2 years ago. We were always putting interest rates up. Sadly, we can't obviously use interest rates to deal with the consequences of the Ukraine war, but what we can, obviously, and what we're doing was to stop the second round effects into domestic inflation. And these three things are really trying to capture those second round effects. So services inflation is important because it has a much bigger domestic component. It is still above 6%, so that is not compatible with a 2% sustained inflation target. It's got further to go. But we have started to see signs of it coming down. Second one is pay earnings. Again, we are seeing signs of it coming down. I mean, yesterday's earnings numbers, I would say again, they were sort of billed as sort of slightly disappointing. Actually, of course, there was quite a marked reduction in pay growth yesterday, just not quite as far as we thought. So again, we're seeing that coming down, but we really need to see more evidence of that to really be convinced that we're on track for 2% sustainably. The third one, and this is the one that we're obviously finding the data most challenging at the moment about, is the quantity side of the labour market. So we've had a very tight labour market for some time. The problem we face is that the ONS, who uses the so-called labour force survey, the LFS, to measure it, the LFS has had quite serious problems with the sampling.
Yeah, we'll come on to that.
Yeah. Now, it's affecting more, for us, the sort of the identification of unemployment and inactivity. There are some other things we can use to, in a sense, proxy employment, and our staff use use anything, frankly, that we think is a sort of decent proxy. There are fewer proxies of unemployment and particularly the split between unemployment and inactivity. So that's the third thing, and that is more challenging at the moment.